What if I told you that a huge billion-dollar company saw its revenue drop by 24%, but its future might actually be brighter than ever? That is the puzzle we are unpacking today with CapitaLand Investment, or CLI for short. They just released their results for the first half of 2025, and look, on the surface, the numbers seem a little shaky, but you and I both know the headline is never the full story. We are going to dive deep into this report and figure out why that revenue number dipped, where the new growth is hiding, and what on earth management's grand plan is. Is this a red flag, or is CLI pulling off a genius pivot to become a leaner, meaner real estate machine? You're going to want to stick around because the answer might just surprise you. All right, before we dive in, just a quick heads up. This video is for information only. It is not financial advice. Please always do your own research or chat with a licensed financial advisor before making any investment moves. Okay, let's do this. So first up, who even is CapitaLand Investment? The easiest way to think about them is not just as a company that owns buildings, but as a global real estate investment manager. They have a massive footprint, especially across Asia. Their business really has two main engines. First, you've got the fee income related business. Just think of this as the asset light part. This is where they manage funds for other people, run hotels and lodging, and manage huge commercial properties, and they earn steady fees for doing it. It's their stable, recurring income. Then you have the real estate investment business. This is the more traditional side, where they actually hold stakes in properties and in those big real estate investment trusts. REITs. Now, the world they're operating in right now is tricky. Let's be honest. The report, which came out August 14th, 2025, talks about geopolitical tensions and a pretty uncertain global economy. Interest rates are high and the mood is just cautious. For a company that deals in massive property deals, that's a tough environment. And remembering that, well, it's the key to understanding everything else. Okay, let's get to the numbers, the ones that made everyone do a double take. For the first half of 2025, their revenue landed at 1.04 billion Singapore dollars. And yes, like I said, that is down 24% from the 1.37 billion they reported this time last year. Next, their profit, the main number that we shareholders care about, that came in at $287 million. That's also down about 13% from $331 million last year. So yeah, on paper, it looks like a sea of red arrows. Revenue down, profit down. But the story is in the why. And here's the twist. The main reason for this drop was a huge strategic move they made, the deconsolidation of CapitaLand Ascot Trust. In simple terms, CLI used to own a controlling stake in Class, so all of Class's revenue, every single dollar, was counted on CLI's books. But late last year, they deliberately sold down their stake. Now, Class is just an associate. This means instead of adding all its revenue, CLI just adds its share of the profits. This one move, this single decision cut CLI's reported revenue by $322 million. So if you take that out of the equation, CLI's revenue actually grew by 7%. See, that changes the narrative completely, doesn't it? And this is where we really see their strategy playing out. Let's look at those two engines again. First, that fee income related business, the part they really want to grow. Revenue here was $564 million. That's up a little bit, about 1% from last year. This was driven by stronger fees from managing hotels and from their listed funds. This steady, predictable part of their business is growing. It now makes up over half of their total revenue. That is exactly what they want. Now for the other engine, the real estate investment business. Revenue here was $519 million, a huge drop of 43%. And this is where that Class deconsolidation really hit. It looks dramatic, but it was completely intentional. They are trying to become asset light, which just means they own less stuff on their own books and focus more on managing assets for others, collecting those sweet fees. It lowers their risk and frees up a ton of cash. So you have one engine, the fee engine, chugging along nicely, while the other engine, the ownership one, is being intentionally downsized to make the whole company more efficient. So did CLI actually deliver on their promises? Well, the company gave an update back on April 30th, 2025, and in this new report, they say their performance, quote, was broadly in line with the guidance provided. This tells us that these numbers, they weren't a surprise to management. This wasn't a miss. This was them doing exactly what they said they were going to do. To really get inside their heads, it's always good to see what the leadership is saying. The group CEO, Mr. Lee Chi-kun, talked about their focus on sectors with strong tailwinds, things like lodging, logistics, and self-storage. And I'm quoting from their news release here, he said, "We are strengthening our fund's platforms. The additions of the Wingate and CCP teams have further increased CLI's bench strength and capabilities." This points directly to two key acquisitions they just made. They bought a 40% stake in CCP Partners, and they fully acquired Wingate Group in Australia. These aren't random purchases. They're designed to get them deeper into fund management and private credit, which, you guessed it, generates more fees. The chairman, Mr. Ko, also gave a roadmap. He said they're accelerating their investments in Australia, India, Japan, and Korea while optimizing what they have in China. That's as clear a plan as you can get. Okay, so this is the part we all care about, right? What is the game plan from here? Well, the outlook is all about execution. First, enhance portfolio efficiency. They're going to be selling off more of their own assets to free up cash. They're moving capital from owning things to managing things. Second, accelerate through M&A. They're going to keep looking for smart acquisitions like the ones they just made to strengthen their fee-generating platform. Third, invest for growth. They're planning to list a brand new REIT in China by the end of 2025. This would be their 8th listed vehicle. And the big one, they have a target of reaching $200 billion in funds under management by 2028. Right now, they're at $117 billion. That is a huge, ambitious goal. So how might investors react to all of this? Well, a knee-jerk reaction would be to just see the 24% revenue drop and sell. But I think smarter investors will look deeper. They'll see the reason for the drop. They'll see the growth in recurring fees. They'll see that management is disciplined, even getting their cost of debt down to 4%. And they'll see a very clear, very ambitious plan for the future. The market's reaction will show us which story wins out, the short-term headline or the long-term strategy. Okay, so let's put this all together. Here's how I see it, what this really means for investors. Let's start with the opportunity. The big opportunity here is to get in on a company that's right in the middle of a massive and so far successful transformation. CLI is shifting from being a traditional property owner to a capital-light investment manager. That business model, when it works, leads to really stable earnings, and it's something the market tends to reward in the long run. Their expansion into private credit is also really smart. It's a high-growth area. Now for the risks. The biggest risk is just execution. This plan is ambitious. It relies on integrating these new companies perfectly, raising money in a tough environment, and selling assets at good prices. That's a lot to juggle. Second, let's be real. They're still a real estate company. A major downturn in property values would still hurt them. And finally, their large exposure to China is both a growth driver and a risk. But the fact that they are actively optimizing it tells me they are on top of it. So the story here isn't about owning shiny buildings anymore. It's about being a super savvy global manager of capital. The first half of 2025, it was a period of deliberate repositioning. That revenue drop is mostly noise. The real signal is the growth in their fund platforms and their clear vision for the future. So there you have it, a classic case of needing to look beyond the headlines. But I want to know what you think. Are you sold on this asset-light strategy, or are the risks just too high right now? Let me know your thoughts down in the comments. And hey, if you found this breakdown helpful, do me a huge favor and hit that like button and subscribe for more deep dives into the companies and trends that are shaping our markets. Thank you for watching, and I'll see you in the next one.